it wasn't just CrowdStrike's fault. A lot of businesses were impacted, but a single point of failure for any business is a problem. And that's why a lot of old school CEOs have a tough time paying big bills to software companies.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Kohler, Wisconsin. We're over here at this Arch MI Fairway Connections meet and greet. So thanks to one of our MI partners out there, Arch MI. Kohler, Kohler, like the toilets and the faucets and the kitchen design. Apparently that's like there's this whole campus here, and it's pretty amazing. I've never been up here. Anyway, there we go. I know, it's in reverse. You'll have to pause it and read it. It's really nice out, it's beautiful. What's going on this week? I traveled again today after a 16-hour day Friday dealing with Delta on a very simple flight. I got crowd-stricken. A very simple flight from Atlanta to Orange County, John Wayne. And it was 11:10 a.m. and it was delayed and canceled, and the next one out was Monday. Yeah, that's not going to happen because I had to be here. Plus I have 4 kids at home and I want to hang out with my family. And anyway, long story short, I had to buy a first class ticket to LAX, and that got delayed and didn't leave. Delayed, gate change, terminal change, another gate change, can't find the flight crew. Got out finally, got home, like 8 LAX drive, down to Orange County, get my car. Today, delay on American connecting through Dallas. So travel, I know it looks fun when you show like where you're at and all the stuff you're doing, but man, it's an ass whip for those out there that know it. Okay, what's going on this week? Enough about me. CrowdStrike's interesting because a single point of failure for businesses is a big deal. 8.5 million Windows customers were affected. That's less than 1% of all Windows customers in the world. And it shut down a lot of stuff. 3 major airlines, Delta, American, and United, and banks and credit unions and businesses. Great shout out to my the PRMG IT team. They were up at 4 a.m. West Coast time, doing all the things they needed to do with the updates and this and that. Keep our Encompass running, which they did, thankfully. What was interesting is I read one of my stock subscriptions gave like a super deep dive analysis on what happened. So many months ago, maybe possibly even years, CrowdStrike had an update that they pushed out that created a backdoor within Microsoft and Linux server systems. And so Linux wasn't affected because this update last week was only for Microsoft clients. But the prior update created a backdoor, which Microsoft didn't discover. They are culpable. CrowdStrike's stock went down 20%, but it wasn't all of them, in my opinion, especially after reading this article. So then the update last week pushed out some new drivers, which goes into the kernel system, KERNEL. I don't get all that, but anyway, bottom line is the backdoor that was created from before was exposed with this new driver, which caused like a problem. So long story short, it wasn't just CrowdStrike's fault. A lot of businesses were impacted, but a single point of failure for any business is a problem. And that's why a lot of old school CEOs have a tough time paying big bills to software companies. So some of the things we're talking about here, in light of all this is, and that's not a shot at any software company, it's just the reality of running a business is that, we pay all this money to run our business and then we're shut down and can't conduct business because of a software failure. It sucks when you're a mortgage guy. So that's the world we live in. Big data coming out this week, Q2 GDP. Remember, our whole economy is based on GDP. And that's a big number that's coming out that we're going to see. And then big inflation data at the end of the week, the PCE, the Fed deflator, personal consumption expenditure. It's a big number coming out, and it is the Fed's, latest test on how we're doing with the war on inflation, which is coming down to see if we get some follow through with the CPI that came out a couple weeks ago. Owner's equivalent rent came down big time. It's really pretty up here. Came down big time, and we'll see if that which isn't weighted as highly on the PCE. We'll see if that comes through with an even lower than expected inflation print. We have existing home sales and new home sales data in addition to the GDP and PCE. So big data points this week to watch. And earnings season continues. So what happened last week in earnings, I think it's worth mentioning what happened. So last Friday was the third Friday of the month. The third Friday of every month in the stock. By the way, I am not a financial advisor. I'm not responsible for your losses, only your profits. When the third Friday is a very big option expiration day, futures expire. The futures market's bigger than the stock market. Anyways, a lot of people trading futures and options, and they were starting to get kind of tilted one way, and that way was market's roaring, things are going up, it's all good. And there's these really big clearinghouses like Citadel and some other ones out there that are the market makers. So if you look up market maker, you can see kind of like, if someone buys like all these options, someone has to buy the other side of the trade. It's like a bookie. So, mean reversion is a real thing. So things get too far extended, too overbought, too out of one side. You see mean reversion. You see all this stock that had to be bought to be able to help pay for the end result of all these options. Well, then the guys that buy the stock, they have to sell the stock, and that brings the prices down, and that leaves a lot of options, worthless, out of the money. 90% of all options bought are worthless. So sell options, a little pro tip there. But anyway, the stock market selling off is a natural part of the grind higher. Now, now that has happened, it's cleared the deck for Q2 earnings season. So what matters fundamentally is how well companies are doing. In the Magnificent Seven, I'm sure you've heard of that. You've got your Google and Tesla are reporting tomorrow, their Q2 earnings, big deal. Both of them are riding pretty high lately, and then they were victim to this sell-off here in the last couple weeks. And then, of course, we've got Microsoft and Netflix, Meta. They're all, coming out in the coming days. And then and I think into next week, I think Apple is August 1st. And then NVIDIA, the big chip maker, is not until August 28th. So, that's the big one, right? So semiconductors, AI, all that stuff. See how it's all doing. So anyway, fundamentals earnings reports can help potentially bring those stocks start trudging higher, right? After the little, digestion the market had in the last couple weeks, right? So it's normal to have some consolidation, some selling, some taking some profits, especially a third Friday of a month when options and futures and all these different things expire. Look up triple witching, look up quad witching. If it was the end of a quarter, like a month ago, that, when Q2 is ending, when quarters are ending, there's rebalancing that goes on there. They call that quad witching. Look up triple witching and quad witching, just some cool terms to check out. Okay, so next week is Fed week. Fed's talking. It's a big deal. 31st, we'll see. I doubt they're going to cut. They should, but they need the cover of the dot plot, the Summary of Economic Projections, the SEP. So they'll probably wait until the September 18th meeting, just to be sure, a little bit longer, that inflation is truly falling like it has been, like a rock. Rates have been improving. We'll see if the PCE later this week can bring the 10-year Treasury another peg down below that pesky 420 number. That's been a nice little floor there, and then we'll keep rocking and rolling here. Hopefully everyone's figuring out what to do with their businesses and get a home equity strategy and get some new technology and network with some new people out here on the road and get your businesses ready, because rates have been coming down since October. Things are getting better. Maybe this is the best the soft landing looks like. I don't know. If bad news is good news until it isn't. So that's one thing we got to look out for. Slowing economy is great for rates and inflation and all that, but then if it slows too much, people start talking about recession again, which, remember, in 2022 and 2023 we talked about recession ad nauseum, and it never really happened, although we had a recession in housing and then rolling in manufacturing and other areas. So anyway, I will get back on Friday after the PCE, so have a great week, safe travels, cheers.
Hey, it's KP coming to you live from Newport Beach. Dory Deli, one of my favorite spots here. It's a great place. PCE came out today, personal consumption expenditure. That is the Fed's deflator, the Fed's preferred gauge of inflation. You know, the thing we've been talking about for like 3 years. So I'm going to talk about it for like 3 minutes. And then I have some other cool stuff to talk about. Not to get too personal, but you know, I just did a 30-day fitness challenge with my boy, Justin Ropling Chauffeur. I have not had a drink for 30 days. And let me tell you, I was in trade show road warrior shape before that. I've only had about 4 today since our podcast, The Last Word, this morning. So we're doing good. It's about 6 o'clock tonight, pacing myself. I did forget to pay my parking, so I hope I don't go back and see a ticket. Here we go. Newport Beach. Doing good. Taking health and fitness seriously. Okay. So the personal consumption expenditure was about as expected, but here's the story there. It's not the headline number that it went up 0.1% for 2.5%, and then core PCE, core, which excludes food and energy, which nobody does in real life, but the Fed does when they decide whether to cut or not, went up 0.2%, and the headline number was 2.6%. But in the last 3 months, core PCE is only 2.3%. That's very close to the 2% target. So the story is, however, that wage inflation, wages went up 0.2% in the month, but with inflation adjusted only went up 0.1%. So that's 1.2% wage inflation annualized. That is not keeping up with 2.3% inflation, or 2.4 if you annualize the same month's number. People's wages not keeping up with inflation is a massive problem for our economy. And that is what the Fed has been looking for to fight inflation, in addition to potential job losses. Now, they're not going to cut next week. We have a Fed meeting next week. They come out on Wednesday. They make their cut, or their announcement, on Wednesday. They're not going to do a cut next week because they don't have the cover of their dot plot, the SEP, the Summary Economic Projections, SEP. That's what, remember, every other Fed meeting, every 6 weeks of Fed meeting, so every 12 weeks, they do a dot plot, an SEP. And that's where they all say, I think the GDP is going to be this, the unemployment rate is going to be this, the inflation rate's this, I'm going to cut this many times. Remember when they said that back in December, they're going to cut 3 times this year? There's still time to do that, by the way. And then they kind of came down to like a little under 2, and then, so they don't have a dot plot this meeting next week. So they're going to wait till September 18th so everyone has cover and credibility. Because what's 6 more weeks to a Fed board that thought inflation was transitory? And in their defense, I'll take the other side of the coin. Once you start cutting, there's no going back. So they're okay with losing some jobs and having people be unemployed at the sake of getting the Fed cutting cycle right. It's like when politicians send people to war, they're okay with deaths. So these are massive decisions that have consequences that us on the street have to deal with every day. But at the macro level, they're dealing with it in a macro way. So that's it on PCE. GDP was a big number. Gross domestic product. I mean, our growth. Like, are we growing? 2.8% GDP was the first read for Q2. Okay. So April, May, and June. The estimate was supposed to be about 2%. Some said 1.8%. Now, 1.6% of that 2.8% on the first reading that came out on Thursday was consumer spending. Remember, 70% of our economy is consumer spending. So as more data rolls in for the months of May and June and gets more finalized, and maybe it's more in line with some of, that wage inflation not growing, we might see that consumer spending isn't as much as we thought it was. And if that's the case, we could see a lower than a 2.8% GDP revision. Remember, there's 2 more revisions. They come out with a first read, then they have a second and a third. So we could still see GDP come down. 0.83% was inventory buildup. That means companies getting ready for Q4, getting ready for the holidays, buying intellectual property. That was a big portion of our gross domestic product, which you compare, that's half. It's almost half as much as the consumer spending, when GDP is supposed to be 70% consumer spending. Not a good sign, especially if it revises down in the next read or the second read. So if growth slows and we get that second and third reading before the next Fed meeting in September, it's more reason for them to cut and start the cutting cycle in September. Anyway, that's about it. Existing homes, we're in the housing business. Might as well talk about existing home sales. Typically it's around 4 million units. They were under 4 million units in the read this week. It was like 3.9, 3.96. Higher rates hurts, right? But rates are coming down. They've been trending down since October. Look at the 2-year note. The spread between the 10 and 2-year treasuries, it's narrowing. And the 2-year treasury, I believe, the yield was at 4.3%. That's about where people in the market and institutional traders think the Fed funds rate will be. The Fed funds rate's at 5.25 to 5.50. So take 5.25 minus a full point. 4.25, the 2-year treasury is almost at that. That's 4 quarter-point rate cuts, or 100 basis points of rate cuts. That's where the market thinks we're going. I don't know when it's going to happen, but GDP slowing, 2-year yield coming down. The 10-year treasury closed today under 420, which was a very, very solid support floor. So, rates are coming down. They're trending down. It's what it is. I know some of us are getting crushed in the stock market. It's probably just a normal pullback, some consolidation, selling, making some profit, taking some money off the table, and then go back into the best businesses on the planet. So don't look at your 401k or stock accounts if you're not a trader. It'll just discourage you. Stay committed to the market. It's great stuff. Keep rocking. We'll check you out next week on Monday. Thank you for those that watched the last word today, and have a fantastic weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.